Hello and welcome to the Providence Quarterly Update for February 2021. My name is Michael Ogg and I'm joined as always by the founder and CIO of Providence, Grant Patterson. Welcome, Grant.
Thanks, Mike.
Now, Grant, I'm always intrigued by your headings on your global outlook and strategy. This one is Uncomfortable Investor. Can you please explain?
Yes, Mike. Look, it's very difficult times, I think, in trying to get any real transparency in regards to asset markets at the moment, as they're being sort of swayed by the central bank policies around the globe. I mean, we've got record global debt. We've got PEs in the equity markets that are up to generational highs that we haven't seen for decades. You've also got rampant speculation, as we've seen in a number of the retail stocks that have been going through. You've got popular politics front stage, and you've got negative real interest rates. So in that environment, it's a very uncertain and difficult time. And so in deploying our clients' capital, it's really difficult. And so, we are invested over the long term, but I'm quite uncomfortable where valuations are at this stage.
Grant, just on the rampant speculation, there's obviously been a lot of talk about GameStop and Bitcoin and what have you. Do you have a view on those sorts of investments? We're
just aware of where the psyche is, if you like, at the moment in the markets. I mean, the volatility is huge in some of these stocks, and you've seen it on the front page of the paper. I mean, we would argue if it's in the press, it's in the price, and you're seeing now Bitcoin, in the press every day as being spruiked as an asset class by Elon Musk or Jennifer Lopez. So you just got to understand where the market is. I mean, Bitcoin now has a value of $850 billion. I mean, that's bigger than the US largest bank, JP Morgan, 8 times the size of Goldman Sachs. It's a third of the UK FTSE market. I mean, it's quite big. Now, I don't know where that's going and where it's going to end. I do understand the thesis behind being concerned about fiat currencies and the debasing of currencies by the printing of money. So I get that sort of thesis, but with the volatility that comes with that, it was down 80% in 2017. I don't think it's a legitimate asset class as yet. It's speculation, and that's the way, why the volatility is coming in. So I think it's just we would avoid where there's the crowd and the herd, because I think it may be different this time, but the result will be the same. Wealth will be transferred from the impatient to the patient.
So Grant, given all that, given the speculation, given the money printing, etc., where are the opportunities? Where are you seeing opportunities in this market?
Well, I think the most important thing, I believe, in the current environment and the uncertainty is to not have all your eggs in one basket. You need to be very, very diversified to protect the portfolios from higher inflation or for a downturn again in the economies. You need to try and cover all of those bases. So number one, diversification is key. And then in those investments, you need to, in my view, focus on value and quality and try and avoid the speculation in markets. Some of the opportunities are in loans. There's some good returns can be made out of, for example, first mortgage fully secured property loans look interesting to us. As we've stated before, regional hospitality assets, we think there's opportunities. Global infrastructure with the huge stimulus package in the States is an area of interest. Gold we have in the portfolios to protect the portfolios. So, the main theme is very, very diversified in this very uncertain world.
And Grant, what's the view on inflation? I mean, inflation is something that we talk about and it's coming. Is it still something which is coming, or has inflation died?
Well, it's certainly now on the discussion on all the investment committees around the globe about whether inflation is going to finally come out after the stimulus that's been around from the central banks and now by the governments. And that's been reflected somewhat in the bond market. US 10-year Treasury bonds, the yields have risen from 56 basis points, 0.56%, to 1.3%. Now, it doesn't sound a lot, but it's a big movement. And so there is some discussion now that inflation will become an issue. In our view, it's not evident yet. Inflation expectations are rising, but there's no real evidence of inflation besides asset price inflation. So it is something that we're watching very closely. We think you need to be aware of duration risk in your assets, and certainly in some of the growth stocks in equities that are priced off very, very low bond yields. I mean, if those bond yields keep backing up, that's going to be a problem for valuations in equity markets. So yes, we're watching it. No, we don't think just yet we're about to see a huge breakout in inflation, but inflation expectations are rising. Bond yield curves are steepening, reflecting the expectation of global growth and the reflation once the vaccines are rolled out throughout the globe.
So Grant, given the view about bond yields and bond yields backing up, at what point does that start impacting asset prices?
Well, it's very hard to know, to find the exact level. I mean, we're really now complete with the financialisation of the global economy thanks to the policies of the central banks. So if you like, you know, risk assets and equities are too big to fail. So if bond yields continue to rise to a level that starts undermining to a significant extent the markets, the central banks will do what they've been doing since 1980. They'll come in and bail out the system and pump the system full of cash, so, and to bring those bond rates down. So I think they've lost control. I think, you know, the codependencies of central banks and governments is a real concern, and I'm not quite sure how they unwind their current policies. So it is troubling, I'd say, and that's why we're making sure that we've got, you know, a fair bit of protection in the portfolios.
So Grant, this is a bit of a crystal ball question, but so how does this all end? What's the end game for this? Printing money, central banks, where does this end?
Well, it's got to be somehow paying down the debt. And that might take generations to pay it down. So, you know, I think we're bringing forward consumption from, you know, now from, you know, the future. So that debt needs to be paid down. Now, that's either going to be through higher taxes, inflating your way out, or defaulting on your debt. And I'm not quite sure which way that will all go. But, you know, I think the way to survive this is to ensure that you don't have too much debt, even with interest rates as low as they are. I think you need to be in real assets that can produce income throughout the cycle. You know, things that produce things, agricultural land, for example, that sort of area. I'm not quite sure where it ends, but it will be volatile. And as I say, it may be different this time, but the result will be the same. There'll be a lot of capital lost by people that are greedy in markets, and when that stops, I don't know.
And Grant, just finally, any updates on Providence you'd like to share with us?
Well, only that we're glad that we've got our client luncheons back on the agenda, so we're looking forward to seeing everyone soon in the client luncheon. And besides that, we will be announcing in the next couple of weeks, which I'm very excited about, is a new senior advisor joining the Providence team. So when that's all complete and concluded, I look forward to making that announcement.
Well, Grant, as always, thank you very much. It's very interesting. And thank you very much for watching. We'll see you next time. Thank you.